Is our economy staring at an inevitable recession? We'll break down the latest warnings about a soft landing and expert predictions on potential market crashes. What's the fate of silver, and is the Fed too late in their actions? Stay tuned as we dissect these pivotal questions.
Today, we'll account for the insights from leading experts on these pressing topics. First up is Julian Brigden, breaking down why the soft landing is a myth. What's next?
First, Julian Brigden breaks down why the soft landing is a myth and warns of an unavoidable recession. Next, Keith Neumeyer reveals the untold story behind silver's price manipulation and its critical role in the future. Danielle DiMartino Booth discusses the Fed's rate cuts and a looming consumer debt crisis. Then, Peter Grandich forecasts a catastrophic market crash and examines political paralysis. Finally, Ophir Gottlieb insists the Fed must act now to save SMBs and stave off a recession. Welcome back to Blockworks Macro. Today we're strapping in for an in-depth look at the soft landing myth with Julian Brigden. Julian is the head of MI2 Partners, and he's here to peel back the layers of economic euphoria.
Absolutely. Julian's bringing some much-needed reality checks to the table today. He really dives into why a so-called soft landing might just be economic fiction. Stick around.
So what's the main argument Julian is putting forward here? Is the soft landing just a pipe dream?
In a nutshell, yes. Julian believes that the Fed's rate hikes aren't enough to permanently squelch inflation. Instead, they've just temporarily subdued it while the economy remains precariously balanced.
Okay, let's dig into those key points. First, the Fed rate adjustments. What's Julian's take?
Julian compares the current scenario to the late 1990s, suggesting that minor rate tweaks without significant hikes won't sustain economic stability. He argues that the Fed needs to do more than just make minor adjustments if they want to avoid long-term issues.
What about market expectations?
Julian points out that the market is overly optimistic, expecting significant Fed cuts to preemptively solve future crises. He warns that the fixed income market's current pricing indicates underlying worries about inflationary pressures, especially with Trump's possible return.
And the labor market. It's been quite the topic lately.
Indeed. He highlights that core services inflation is tied closely to the labor market's performance. Without a substantial weakening in the labor market, the short-term tweaks won't achieve the desired disinflation.
So what does Julian predict will happen as we move into 2025?
He sees a few potential scenarios. One, we may hit a recession, necessitating drastic rate cuts. Alternatively, if Trump's policies drive inflation, you could see rate hikes instead. Either way, big changes are on the horizon.
And what about market reactions?
He foresees possible inflation spikes due to corporate pricing power and geopolitical risks. This could force the Fed's hand, and weak market fundamentals could lead to significant market corrections.
So, wrapping up, what's the final takeaway here?
Julian urges caution. The idea of a soft landing might sound nice, but it's improbable. Instead, we should prepare for inflationary shocks and potential policy upheavals. Lukewarm optimism won't cut it in these uncertain times.
Welcome back to Kitco News, everyone. Today, we're diving into an eye-opening interview from the Rick Rule Symposium on Natural Resource Investing. Our guest is none other than the silver aficionado, Keith Neumeyer, CEO of First Majestic Silver.
Absolutely. Keith is known for his candid views on the precious metals market, and he's got some fascinating insights into the future of silver, its price manipulation, and the supply-demand dynamics. It's a silver saga you won't want to miss.
So, what's the core message from Neumeyer's interview? What's the big silver lining here?
The main takeaway is that silver is massively undervalued. Neumeyer argues that the metal's price is being manipulated and that there's a growing supply deficit. Given silver's essential role in industries like electronics and renewable energy, its price should be much higher.
All right, let's unpack those key points. What's this about price manipulation?
Neumeyer criticizes regulatory bodies for stepping in when silver hits the $30 mark, effectively keeping prices down. He explains that trading desks at big banks treat silver as just a number, ignoring its industrial and strategic importance.
Sounds like a real silver conspiracy. Now, what did he say about the supply-demand deficit?
There's been a continuous 4-year deficit in silver production, and it's huge, 240 million ounces per year. With only 850 million ounces produced annually, the deficit is expected to grow thanks to skyrocketing industrial demand.
Wow, that's a serious shortage. What about institutional investors? Are they jumping on the silver train?
Not yet, and that's a big concern for Neumeyer. He believes institutional investors should be supporting the silver market, but so far, they're missing in action. Retail investors are interested, but we need the big players to step in.
And lastly, how does the geopolitical landscape affect silver?
The recent election in Mexico could change mining regulations, which is crucial for companies like First Majestic. Plus, silver's role in the green revolution and renewable energy only underscores its increasing importance.
All right, time for some crystal ball moments. What are Neumeyer's predictions?
First up, he sees silver prices climbing higher, potentially hitting $50 or even $70, driven by that massive supply deficit and industrial demand. Also, he believes institutional investors will eventually realize silver's value and start pouring money into the market.
So, wrapping it all up, what should our viewers take away from this?
Keith Neumeyer's bullish on silver, emphasizing its undervalued state and critical industrial role. He calls for greater institutional investment and awareness of silver's importance. The silver future looks bright indeed, and investors should definitely take note.
Welcome to Kitco News. Today's show is a hot one. Are the Federal Reserve's rate cuts arriving too late, and is a consumer debt crisis looming? Buckle up as we dive in with Danielle DiMartino Booth.
Absolutely. Danielle's got a treasure trove of insights, thanks to her decade-long stint at the Fed. Let's jump right in.
So what's the main concern Danielle is raising about Jerome Powell and the Federal Reserve?
In a nutshell, Danielle argues that the Fed's actions are too little, too late. She believes Powell knows he's behind on addressing economic concerns, which could lead to drastic measures down the line.
All right, let's unpack some key points. Starting with Jerome Powell's timing. What's Danielle saying there?
Powell admits they're cautious about reducing policy restraint too soon, but Danielle thinks this caution could backfire. He might have to make larger, more abrupt rate cuts later this year.
Interesting. Now, she also touched on market dynamics. How do flows come into play?
Yes, Danielle emphasizes that it's not just about stock prices, it's the flow of money. Whether it's consumer spending or government expenditure, the devil's in the details. Despite some stock highs, the market shows signs of stagnation.
That makes sense. Shifting gears, what's the scoop on the labor market?
The job market looks grim. According to Booth, net job losses actually began in October 2023. Recent revisions in job data show deeper cuts and increasing bankruptcies, signaling a tough labor market.
Yikes! Danielle mentioned corporate cost cutting with an Elon Musk twist. What's that about?
Indeed. Following Musk's drastic cuts at Twitter, many companies have slashed their workforce. Tech and AI advancements have exacerbated this, leading to more layoffs and offshore jobs.
Man, AI is taking over. What about the consumer debt scenario?
The consumer debt situation is alarming. Households now spend more on non-mortgage debt than mortgage debt. With student loan payments resuming soon, delinquencies will likely rise, adding to the economic strain.
Not good at all. How are commercial real estate and banks faring in this drama?
Commercial real estate is deeply impaired, and smaller regional banks are on shaky ground. The banking sector could see more consolidations or even failures if things don't improve.
Wow, tough times ahead. Danielle also hinted at political dimensions. What's up there?
Both major parties seem set on high spending, but Danielle warns that Congress might need to act as a fiscal check. The Fed could be reluctant to bail out additional debt without another major crisis.
All right, crystal ball time. What does Danielle foresee?
She predicts significant rate cuts, possibly starting in September and totaling up to 150 basis points by year end. She also sees the stock market reaching highs until these cuts trigger a correction.
Sounds plausible. Any predictions on the labor market?
Absolutely. Job losses are expected to accelerate, especially with upcoming corporate earnings reports. Many companies will announce deeper cuts to survive.
Ouch! And the consumer debt crisis?
Expect increased delinquencies, particularly when student loans resume in November. The consumer debt issue will heavily burden spending and credit.
Things are looking grim for the banks, aren't they?
Indeed, Regional banks will face consolidation pressures or failures as commercial real estate values drop and debts rise.
What about the fiscal policies from our lovely government?
Danielle foresees continued high spending, with Congress possibly needing to intervene to avoid further debt issues. The Fed, meanwhile, could be less inclined to monetize additional debt without a new crisis.
Wrapping it all up, what's Danielle's final stance?
Danielle calls for timely and decisive Fed actions to stave off deeper economic woes. With consumer debt ballooning and job losses growing, it's time for everyone to prepare for tighter fiscal policies and proactive measures.
Sage advice. Thanks for tuning in, folks. Remember to like, subscribe, and stay tuned for more insights from Kitco News. Welcome to the David Lynn Show on YouTube. Today's episode is all about navigating the stormy seas of potential market collapse and socio-political turmoil, featuring none other than market sage Peter Grandich. Fasten your seatbelts, folks.
Absolutely. Peter takes us through a roller coaster of insights, warning us about looming market crashes, possible civil unrest, and even the potential breakup of the European Union. It's a lot to digest, but absolutely fascinating.
All right, what's the big takeaway from Peter Grandich's ominous proclamations?
The core thesis is quite alarming. Peter warns that widespread political paralysis, severe socioeconomic divisions, and market complacency point towards an impending market collapse and increased social unrest. Buckle up.
Heady stuff. Let's break down those key points, starting with the markets. What's Peter's outlook?
Peter is bearish, focusing on long-term risks. He warns of a potential 30 to 50% market crash over the next 3 to 5 years due to economic downturns and political instability.
Moving on to political factors, how bad is the situation according to Peter?
Pretty grim. He highlights the complete deadlock between Democrats and Republicans, each becoming more extreme, making it nearly impossible for meaningful legislation to pass.
Interesting. And what does he say about social unrest and Ray Dalio's predictions?
Peter agrees with Ray Dalio about the likelihood of social unrest, even civil war, due to extreme polarization and a crushed middle class. He contends that the national mood is dangerously divided.
All right, let's talk precious metals. What's Peter's take on gold and other commodities?
Peter is bullish on gold, predicting prices could soar to $2,700 to $3,000 per ounce by 2025. He emphasizes gold as a safe haven during economic uncertainty, unlike conventional investments that are becoming less reliable.
Time to peer into the crystal ball. What does Peter foresee?
Peter predicts a long-term market crash of 30 to 50%, driven by political instability and economic mismanagement. Additionally, he expects the European Union might dissolve due to rising nationalist sentiments and fragmented politics.
Summing it all up, what are Peter's final thoughts?
Peter's parting advice includes focusing on capital preservation over appreciation and returning to pragmatic, morally grounded financial planning. He stresses the need for realistic approaches to navigate the challenging times ahead. Solid advice, if you ask me.
Welcome to the David Lynn channel on YouTube. Today's hot topic is the Fed about to steer us straight into a recession. Buckle up for a wild ride with insights from Ophir Gottlieb, the brilliant CEO of Capital Market Laboratories.
That's right, we're diving deep into why the Fed's decisions are critical right now and how they could make or break small and medium-sized businesses, which Ophir says are barely hanging on. Stay tuned for some eye-opening perspectives.
So, what's the main takeaway from David Lynn's discussion with Ophir Gottlieb? Are we really on the brink of a recession?
Yes, according to Ophir, the Fed's current monetary policy is like playing chicken with a cliff. If they don't cut rates by September, the U.S. could nosedive into a recession. He emphasizes that SMBs are already struggling and any delay could push them over the edge.
Ouch. Sounds like tough times ahead for small businesses. What are the main points Ophir highlighted?
First, he pointed out that over half of SMBs are unable to pay rent. This isn't just a blip. It's a trend that's endangering their survival. No long-term capital means they're shrinking or going bust. They're like the economy's canaries in the coal mine.
And how's the Fed involved in this mess?
The Fed's tight monetary policy is adding fuel to the fire. Ophir criticizes them for being rigid and not cutting rates despite rising unemployment, slowed GDP growth, and wage inflation hitting lows. It's like tightening a screw until it strips.
Sounds dire. What's the timeline for action according to Ophir?
Ophir argues that by September, if the Fed hasn't cut rates, we might be looking at full-blown economic distress. Even a small rate cut now could signal stability to SMBs and encourage reinvestment, like throwing them a lifeline.
All right, now switching gears to the tech sector. What's happening there?
The tech sector, especially those involved in generative AI, is soaring. Companies like NVIDIA are leading the pack, but Ophir warns that sustainable dominance requires relentless innovation and strategic moves. No resting on their laurels here.
Crystal ball time. What predictions does Ophir make?
First, he sees a rate cut by September as crucial. Without it, we could plunge into a recession. He's also optimistic about new economic data pushing the Fed to act sooner, possibly as early as July.
And in the tech world,
if the Fed cuts rates, expect more evenly distributed gains across the market. The current tech titans won't hog all the glory. Smaller businesses might finally get their time in the sun. It's like sharing the last slice of pizza.
wrapping it all up, what are the final big takeaways?
Ophir's message is clear. The Fed needs to cut rates now to save the economy and avoid a recession. He also stresses the importance of informed investing in tech and AI sectors, while being mindful of the massive changes on the horizon. It's a call for strategic action amidst looming challenges.
In today's analyses, Julian Brigden dismantled the idea of a soft landing, asserting that an inevitable recession looms due to insufficient Fed rate hikes.
Keith Neumeyer highlighted how silver's manipulated prices and industrial demand forecast a bullish future. Insightful stuff.
Danielle DiMartino Booth stressed the necessity of timely Fed action to avoid deepening the consumer debt crisis, while Peter Grandich warned of market crashes and political tumult.
Lastly, Ophir Gottlieb urged the Fed to act swiftly to support SMBs and stave off a recession. Thanks for watching. Like and subscribe for more.
Thanks for watching Financial News in Review for July 10th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.